Hello everyone, I'm Elliot Yu. If you've been following my work and the work of my colleague Roger Conrad, you know we focus on energy markets and identifying the stocks best placed to benefit from trends underway in the industry. But today I want to step back. I want to zoom out and I want to look at the big picture. And in particular, something I like to call the Great Cycle. Specifically, over the past few months, we've witnessed a historic move in precious metals and precious metal markets, particularly silver. And most energy stocks are completely overlooking this. And in fact, my research confirms that's a huge and potentially very costly mistake. Simply put, the history of prior commodity cycles suggests that in the next few years, returns for the best placed energy stocks in our coverage universe will look a lot like eye-popping gains we've seen in gold, silver, and related mining stocks since the end of 2022 and the beginning of 2023. Listen, in late January of this year, silver didn't just rally. It went absolutely parabolic. On Thursday, January 29th, silver prices cruised well over $120 an ounce intraday. At those highs, silver prices were up a whopping 69.9% year-to-date in 2026 alone. And that's with less than a month into the year. At those highs, silver prices were up almost 300% over the prior year, and almost sevenfold since the late 2022 lows. To put that in perspective, we need to look at the long-term chart here, which I just threw up on your screen. For nearly half a century, the $50 per ounce level was a psychological and technical brick wall for silver. It stopped the Hunt Brothers rally in January 1980, and it stopped the post-financial crisis surge in the spring of 2011. Yet, as you can see, silver has now more than doubled since breaking definitively above that $50 mark. Why does silver matter to an energy investor? Because energy and metals are two sides of the exact same coin, commodities. While the fundamentals for silver, industrial demand, and its status as a monetary hedge are very different from the supply-demand balance for crude oil, the cycles they inhabit are deeply linked. You see, in a commodity supercycle, metals are often the canary in a coal mine. They move first, they move fast, and they signal that the era of paper asset dominance, US tech stocks in the NASDAQ this time around, is ending. Energy stocks are off to a strong start in 2026, up about 18% year to date. In fact, it's the best performing sector in the S&P 500 so far this year, with materials just behind energy up 14.4%, led by names, as you probably gathered, like Newmont, the only pure play gold mining stock in the S&P 500 index. However, since the end of 2022, the past 3+ years, there's just no contest, with the S&P 500 Energy Index up just 38.6%, compared to Newmont up 156%, and the Philadelphia Gold and Silver Mining Index up on the order of 245%, while the so-called junior miners are up about 275%. My thesis is simple. If history is any guide, before the current commodity supercycle is complete, the charts of oil prices and energy stocks will look much like silver, gold, and mining stocks do today. And that brings me to this, the 1970s blueprint, understanding the push forward. A common frustration and a common question I hear from readers and investors is something like this. If we are in a commodity bull market, why isn't my energy portfolio keeping up with the explosive moves I'm seeing in silver and gold? The answer lies in what I call the push forward effect. To see this in action, we have to look back at the 1970s. I've pulled dividend and split adjusted data for Agnico Eagle Mines. This is a senior gold miner, senior gold producer. And I'm comparing it to the big oil giants. These are the big US oil giants, ExxonMobil and Chevron. Now look at the period starting in February 1973. Agnico Eagle, that's the blue line on the chart, spiked higher into early 1974. While both Exxon and Chevron actually drifted lower. If you were an oil investor in early 1974, you probably felt left behind. But watch the transition. As the gold miner fell backward to earth into early 1975, Chevron and Exxon bottomed out and began a steady rally. By the time the late 1970s arrived, the oil majors followed the metals path almost perfectly. Indeed, you could say the charts of Exxon and Chevron look very similar to Agnico Eagle, just pushed forward several months. Energy and precious metals move higher as a group, but they operate on slightly different schedules. Today, silver had its Agnico moment. Energy is just breaking out from that 1974 style drift before the big move. So let's look at a slightly more modern cycle for precious metals and for energy, the aughts super cycle, and what's called the brown bottom. I'll explain that in a moment. Let's look at the next great iteration of the great cycle. That's the late 90s through 2011. Now, this was an era defined by extreme bearishness towards hard assets. Now, here's a chart of gold and silver in that era. This chart shows the price of gold as an orange line from late 1994 through the end of 2011, while the blue line represents silver over this same period. As you can see, for most of the late 1990s, both metals were basically marching in place in a trading range with a downward drift. Silver hit lows well under $5 an ounce in the summer of 97, while gold bottomed out in the summer of 99 around $250 an ounce. In 1999, we had what's called, rather inelegantly, the brown bottom, named after Britain's then Chancellor of the Exchequer, Gordon Brown. For those unfamiliar, Britain's Chancellor is essentially equivalent to the Treasury Secretary here in the US. Now, Gordon Brown did go on to also become Prime Minister of the UK later on. But in May 1999, as Chancellor, Brown announced that the UK would sell a massive portion of its gold reserves, about 395 metric tons, which is about 12.7 million troy ounces. Now, they sold this via a series of auctions between 1999 and 2002 at an average price of just $275 an ounce. To put that in perspective, Britain's gold reserves prior to this sale were around 715 metric tons. So these sales represented more than half of Britain's gold reserves, sold off right near the lows of the cycle. It turned out to be one of the worst time trades in the last 50 years, considering gold eventually peaked near $1,900 an ounce in late 2011. So let's flip over and look at the price of West Texas Intermediate crude oil in this same era. Now, while gold was bottoming around $250 an ounce in 99, oil was hitting an absolute low of $11 a barrel in late 98. In March 1999, The Economist magazine even famously ran a cover titled "Drowning in Oil," predicting we'd hit $5 a barrel. Oil then rallied to about $40 a barrel by late 2000, pulled back amid the 2001 recession, and then finally broke higher for good, above its 1990s range in late 2004. The ultimate peak for oil itself was the summer of 2008 at around $150 a barrel for WTI, though prices remained near $100 a barrel into the second half of 2014. And most energy stocks we cover rallied to fresh highs after 2008. Just like today, gold broke out first. Gold surged over $425 an ounce in 2004, and silver followed in late 2005. Oil didn't catch fire until late 2004, but when it did, it hit $150 a barrel by 2008. The takeaway? Commodity patterns aren't identical, but they rhyme. One more chart in this regard, just so you can see we're not just cherry picking here. Now, here's a chart of corn futures prices since the summer of 2000. This is in cents per bushel of corn. Much like gold, silver, and oil, corn prices broke well above their late 90s and early 2000s range by around 2006 and spiked to well over $8 a bushel in the summer of 2012, when a whopping 60% of U.S. farms, the core of the Corn Belt, were suffering from moderate to extreme drought conditions. Indeed, 2012 was the driest year in the United States since the 1950s. The fundamentals for corn prices are obviously very different than for precious metals, or oil, or natural gas, but the same commodity price cycle from the late 90s lows to the 2008 to 2014 peaks ultimately powered significant rallies in energy, soft agricultural commodities like corn and soybeans, precious metals, and base metals. The cycles aren't perfectly aligned, but the correlation is tough to deny. When the supercycle turns, everything eventually participates. It's a matter of when, not if. So let's move on to this, decoding the great cycle. Now let's talk about the why. What I call the great cycle is a long-term handoff of leadership between financial assets like stocks and hard assets, commodities. That's repeated multiple times over literally centuries. So let's look at this data since the 1850s, the middle of the 19th century. This chart shows nominal annualized returns, not adjusted for inflation, for 6 different assets by decade since 1850 to 1859. Now, all returns are in US dollar terms. The equities are represented by the light blue bars on my chart. You can take a look at the period from 1950 to 1969, that 2-decade period that I've boxed in a black rectangle. Over this 2-decade period, US equities outperformed and commodities offered little or no nominal upside. Indeed, wheat prices, which are the green bars on your chart there, actually fell in nominal terms through this period, while the CRB index as a whole, that's the Commodity Research Bureau index of all commodities, as a whole, it offered only a slight positive return in each decade. Now, once you adjusted that for inflation, both wheat and the broader commodity complex offered negative real inflation-adjusted returns in both the 1950s and the 1960s. Oil prices, that's the light green bars on my chart, were weak in the 50s and the 1960s as well, producing only a slight positive return in nominal terms in each decade. Then came the 70s. The script flipped. Equities offered a 5.77% annualized return, which sounds okay, but once adjusted for inflation, that was actually negative 1.51% annualized on a real basis. Commodities were the only source of wealth creation in that decade, with gold up 30.7% a year annualized and oil jumping up 28.04% annualized. Then, once again, equities took over from a return perspective in the 80s and the 1990s before commodities regained leadership again in the 2000 to 2009 era. Now go back even further and look at how these cycles have played out over even longer periods of time. Go back to the 1850s. Equities produced annualized gains of just 1.62% on a nominal basis and 0.07%, basically nothing, in real terms. Meanwhile, wheat returned 5.7% annualized. Equities boomed in the 1920s, while wheat, copper, and the CRB index fell. Of course, financial markets are inherently noisy. Cycles in various financial assets don't perfectly line up with calendar decades, and different commodities have under or outperformed in various cycles over time, as you can see. However, there is a pattern here of multi-year periods where US stocks beat all other assets, followed by multi-year periods where stocks lag and commodities shine. That's what I call the great cycle. And the more recent iterations favoring commodities have been the periods from 1968 to 1982, 1998 to 2012, and I believe the period starting in 2020 to 2022 that's likely to extend well into the 2030s. In short, we've just finished a 14-year era of US asset hegemony. From July 2011 to January 2025, the S&P Technology Index was up over 972%. Meanwhile, WTI crude oil and silver were actually lower in that same period. We moved from the bottom of that cycle in 2011 to what I believe was the top early last year. History suggests the next 5 to 10 years will look much more like, say, that 2002 to 2011 period, where commodities led and the NASDAQ lagged. The value of the US dollar and speculator sentiment are also all part of this. Now, the dollar peak, contrary to media narratives, there's no long-term correlation between the US dollar and oil prices. Indeed, some of the most powerful rallies for oil in history, including the move from 2020 to 2022, have occurred in the context of a stronger dollar, not a weaker dollar. However, the dollar is related to the great cycle in big picture terms when you zoom out. When U.S. stocks and assets dominate, the dollar strengthens as capital pours into the U.S. markets. And when commodity markets dominate the investment cycle over equities, the dollar tends to weaken. The U.S. dollar index is probably the most widely followed metric of the exchange rate of the dollar against a trade-weighted basket of foreign currencies. However, it does suffer from a handful of structural drawbacks. Chief among those is the fact the dollar index mainly tracks the value of the US dollar against the euro. Now, the euro accounts for just under 60% of the moves in the dollar index, followed by the Japanese yen at about 14% and sterling, that's the British pound, at 12% or so. Now, of course, that's at least in part a vestige of the good old days, right? When Europe had multiple currencies issued by individual national governments. All 6 currencies in the US dollar index, only a half dozen in there, are issued by developed countries. And it doesn't include major emerging markets which are major trading partners as well of the United States, like Mexico or China. The second drawback of the US dollar index is that it's a nominal index, so it's not adjusted for the relative inflation rates in the US compared to our key trading partners. Now, that can distort the economic message provided by the dollar's strength or its weakness. So enter the Real Broad Dollar Index, which is a different index maintained by the Federal Reserve. The Real Broad Dollar Index measures the value of the US dollar against a much wider basket of foreign currencies. There are currently about 26 in there. And it's adjusted for relative inflation rates in each of these countries compared to the United States. And while individual currency weights are fixed in the US dollar index, the Fed rebalances the Real Broad Dollar Index annually based on actual trade data, such that currencies issued by trading partners with growing importance to the US gain a greater weight in the index. You'll note that there are actually 2 lines on my chart. The blue line is the Real Broad Dollar Index with weights based solely on the value of physical commodities and manufactured products, goods trades, between the US and trading partners. We have data on that index monthly dating back to January 1973, but that index was actually discontinued in 2019. Now, the red line is the current Broad Dollar Index, which weights currencies by total trade in both goods and services. Now, this is a crucial and more relevant metric because trade in services has become an increasingly important component of total trade over time. However, we only have monthly data on this version of the Broad Dollar Index since 2006. So to get an idea of the longer-term trends in the dollar through several iterations of the Great Cycle, I've included both indices on this chart. Now, in practice, where there is overlap from 2006 to 2019, a 13-year period, both versions of the Broad Dollar Index exhibit similar trends. The most crucial takeaway: in January 2025, the dollar was the strongest it's been on this basis since the spring of 1985. That's 40 years ago. In 1985, the rapid rise in the value of the dollar prompted a globally coordinated intervention to weaken the currency. This was known as the Plaza Accord because the deal was actually struck at the Plaza Hotel in New York City. Under the Plaza Accord, central banks in countries like West Germany, Japan, sold US dollars and bought other currencies to weaken the dollar. There are a handful of clear implications in my view, starting with this. Take a closer look at my chart above, and you'll see the Real Broad US Dollar Index bottomed in July 2011 and peaked in January 2025. So let's look at some returns for key assets over that time. As you can see, strength in the US dollar over this period corresponded to strength in the value of US financial assets relative to just about any global alternative, right? The S&P 500 was up almost 467% over this period, compared to a 73.5% gain for the MSCI World Index, including the US, a little over 97%, excluding the US, a little over 97% for MSCI Japan, and barely 16% for emerging markets. The S&P 500 Technology Index, an industry group where US companies dominate, was up over 972% in this near 14-year period, while the NASDAQ 100 soared 908.34%. So even in bonds, the U.S. dominated. The Bloomberg U.S. Aggregate Bond Index rose a little over 29% over this period, compared to an 8% decline in the value of international corporate bonds and even bigger losses for global government bond markets. As I said, the rally in the dollar since the summer of 2011 corresponds to a period of U.S. asset dominance, and we now appear to be coming off the top of the cycle. The last down cycle for the real broad dollar index was from early 2002 until mid-2011, and asset returns looked very different in that era. So as you can see here on this table, in that 2002 to 2011 era, U.S. stocks were a notable underperformer, with the NASDAQ 100 and the S&P 500 up just 54.5% and 42.4% respectively, compared to a 61% gain from MSCI Japan, 127.4% for MSCI Germany, and a whopping 384.7% for MSCI Emerging Markets. Meanwhile, gold, silver, oil, and commodity levered groups like the S&P 500 Energy Index all led the league tables for asset returns. Now, these cycles never line up perfectly for all assets. For example, the S&P 500 financial sector is right at the bottom of my league table for that 2002 to 2011 era. However, you got to remember, 2011 was just after the lows of the financial crisis that decimated that group in particular. If we looked at returns from the late 1990s up through 2007, financials, key value group, were actually one of the top performing groups in the US. Simply put, if we consider the recent surges in commodities like gold, silver, and copper, or the dramatic outperformance of international stocks over their US peers since early last year, the returns for financials over technology recently, that's all consistent with a turn lower in the Great Cycle into a period more like 2002 to 2011. Just remember that the Great Cycle is a long-term cycle. So these typically last in the region of 10 years or much longer than that in some cases. And we're just getting started. So our view has been and remains that the next 5 to 10 years will look a lot more like that 2002 to 2011 period. Now let's talk about speculator sentiment. This is actually one of the most powerful intermediate to longer term indicators you'll encounter in these commodity cycles. Late last year, crude oil was the most out of favor it's been in more than 15 years. So this chart shows the net position, so that's gross long position less gross short position for speculators known as non-commercial traders in the West Texas Intermediate WTI crude oil futures market here in the US. It's a data set reported by the Commodity Futures Trading Commission, or CFTC, on a weekly basis. Usually comes out after the close on Friday afternoons. This data series includes both futures market positions and options on those futures. So that would be, long calls less long puts. And I'm presenting the data from January 2010 into January of 2026. So as you can see here, at one point in late October 2025, speculators were as bearish oil as they have been at any time in the past 15 years, and more than 15 years. And on October 21st, 2025, speculators' position was almost 3 standard deviations below the 156-week, which is a 3-year simple moving average. That largely reflected sort of negative media narratives out there and the bearish supply and demand forecasts for oil we saw published by the likes of the perennially bearish International Energy Agency, or IEA. However, when traders are that negative on oil, it's usually a signal that we're near an important low. Now that's partly because with speculators already so bearish, a ton of bad news is already priced into the crude oil market. Just remember, a known fundamental is a useless fundamental, right? So if the bear case is well known, well understood, and actually represents the market consensus, the widely held belief of the crowd, then bad news for oil won't then have much of an impact on prices at all. And good news can actually prompt waves of buying and short covering. This point is crucial. Traders were similarly bearish on silver just 3 years ago in late 2022 and early 2023. with the metal trading below $20 an ounce. Now this chart shows the current net position of speculators and US traded silver futures, measured in terms of standard deviations above or below the 3-year 156-week average. In late 2022 and early 2023, speculators were as much as 2.82 standard deviations bearish silver on this basis, similar to the levels we saw in WTI futures towards the end of October last year. Recall that in late 2022 and early 2023, the narrative in the media was that a strong dollar at the time, right, and rising real interest rates would put downward pressure on precious metals prices. At the time, as I said, silver was trading under $20 an ounce, reaching lows right around $17.50 in the autumn of 2022. And of course, as I noted earlier, it rallied around sevenfold to the recent highs from that point of maximum negative, maximum bearish sentiment. The time to boost exposure to commodity and related stocks is when they're most out of favor with speculators, and the media narratives are all bearish, much like precious metals 3 years ago or oil and energy stocks right now. The conclusion is clear. We are at the beginning of a new leg of the great cycle. We've seen the metals flare. We've seen the dollar retreating from a historic 40-year peak. And we see energy sentiment just coming off 15-plus year lows. History tells us that oil and energy stocks will eventually follow the path that silver and gold have already blazed. But understanding the great cycle is only the first step. The real challenge for investors is identifying which specific stocks in the energy patch, from producers to midstream giants, are best positioned to capture this supercycle move. That's exactly what we do every day in our energy-focused service. I want to help you navigate this rotation, which is why I'd like to invite you to try our service with a 30-day free trial. This isn't about a hard sell. It's about providing you access to our deep dive research, our model portfolios, and our specific buy and sell alerts that are grounded in the data like what I just showed you. I want you to see our work first, with my compliments, before you decide if the service is for you. If you don't find our publication and our energy-focused model portfolio useful, if it doesn't fit with your investment plan, you can cancel before your free trial is up and never be billed for the service. I guarantee it. There is no obligation, and it's a way for you to see how we're putting this great cycle thesis into practice for our members right now. Click the link below to start your free trial. Let's ride this energy supercycle together. I'm Elliot Gu, and I look forward to greeting some of you as new free trial readers here in just the next few minutes. Thanks again.